The Federal Reserve just crossed $9 trillion in assets, while simultaneously reporting unrealized losses exceeding $1.1 trillion on its bond portfolio. The Bank of Japan is trapped in yield curve control, printing yen to buy its own government bonds at a rate that now exceeds 100% of GDP. The European Central Bank is buying the debt of governments that can't fund themselves. And every major central bank is now coordinating language around digital currency frameworks, while gold purchases by central banks outside the Western system hit a 55-year high. This is not a coincidence. This is the architecture of an exit. And if you're still holding wealth in instruments that depend on confidence in the old system, you're holding the wrong side of the trade. In the past 18 months, we've seen 3 developments that don't make headlines, but define the macro landscape. First, the U.S. Treasury market experienced multiple episodes of illiquidity, where primary dealers refused to absorb supply. That's the deepest, most liquid market in the world, failing to clear at auction without Fed intervention. In October 2023, a 30-year Treasury auction saw the highest yield tail in over a decade, a signal that buyers are demanding higher compensation for holding long-dated U.S. debt. That's not a market functioning normally. That's a market pricing in structural doubt. Second, Bitcoin ETF approval in the United States coincided with the largest sustained drawdown in exchange-held Bitcoin since 2020. Over 300,000 Bitcoin moved off exchanges in 6 months. That's not selling. That's migration to custody, institutional custody. When BlackRock, Fidelity, and a dozen other asset managers launched spot Bitcoin ETFs, the narrative was adoption, but the actual mechanical effect was that coins moved from retail exchanges into segregated institutional vaults. The ETFs didn't create new demand, they formalized the exit of existing supply from the liquid market. Third, sovereign gold repatriation accelerated. Germany, Poland, Hungary, and others demanded physical return of reserves held in New York and London. Not certificates, not allocated accounts, physical bars. Moved to domestic vaults. Poland repatriated 100 tons. Germany has been steadily pulling back the 3,400 tons it stored abroad since 2013. These are not symbolic moves. These are operational decisions that signal a breakdown in trust within the central banking system itself. These 3 data points represent the same phenomenon expressed through different asset classes. Capital is moving out of the legacy financial system and into settlement finality. Whether that finality is a vault in Warsaw or a hardware wallet in Singapore doesn't matter. What matters is the direction of flow. And that flow is one way. The core problem is not inflation. It's not interest rates. It's not even debt levels. The core problem is that the global monetary system is structured on a foundation of infinite elasticity, and that elasticity is now being weaponized, rejected, and circumvented simultaneously. Let me explain. A currency with infinite elasticity can be expanded to meet any political, fiscal, or financial obligation. Need to fund a war? Print. Need to bail out a bank? Print. Need to service debt? Print. This system worked as long as the rest of the world accepted dollars in exchange for goods, resources, and labor. But acceptance is not a law of nature. It's a function of trust, coercion, and alternatives. Trust is breaking. The coercion is becoming visible. And the alternatives now exist. When the U.S. freezes $300 billion in Russian reserves in 2022, every non-Western central bank recalculates risk. When the EU discusses confiscating interest on frozen assets to fund Ukraine, every sovereign wealth fund starts asking, what is an asset if it can be nullified by decree? When Switzerland, a neutral country for centuries, freezes Russian oligarch accounts under pressure from NATO, the concept of Swiss banking secrecy dies, not because of law, because of precedent. This creates a problem for savers and investors who are not sovereigns. If a nation-state with a military, a central bank, and treaty obligations cannot trust the security of its reserves, what makes you think your brokerage account, your pension, or your treasury bond is secure? The answer is, it's secure until it isn't, and the definition of isn't is expanding. Capital controls are already in place in over 40 countries. Withdrawal limits, foreign exchange restrictions, reporting requirements that turn every transaction into a surveillance data point. This is not theory, this is policy, and it's accelerating. Argentina has capital controls. China has capital controls. Nigeria limits dollar access. Lebanon's banks have informal controls that prevent depositors from accessing their own savings. These are not failed states in the traditional sense. These are middle-income countries with functioning governments. And they cannot allow free movement of capital because free movement would expose the insolvency of their banking systems. The system is not designed to let you leave cleanly. It's designed to trap liquidity inside the perimeter while the managers of the system decide how to allocate losses. And if you're inside that perimeter when the allocation happens, you don't get a vote. You get a notification. Your pension was restructured, your deposit was bailed in, your currency was redenominated, And the explanation is always the same. It was necessary to preserve stability. But stability for whom? Not for you. So let's talk about the exits. There are two categories of assets that exist outside the elasticity trap: physical hard money and cryptographic hard money. Gold and silver in the first category, Bitcoin in the second. Each operates through a different mechanism. Each has different strengths, weaknesses, and attack surfaces. And understanding the distinction is critical. Gold and silver are physically scarce, historically recognized stores of value with a 5,000-year track record. They require no counterparty, no network, no electricity. You hold the metal, you own the value. Governments have tried to ban private gold ownership, Executive Order 6102 in 1933 being the most cited example, but enforcement was inconsistent, and gold remained valuable throughout. Silver has never been confiscated at scale because it's too dispersed and too industrially necessary. The strength of precious metals is settlement finality. The weakness is portability, divisibility, and the fact that most holders don't actually hold physical. They hold ETF shares, allocated accounts, or pool certificates. Those are claims, not metal. And in a crisis, claims get restructured. Here's what most people don't understand about gold ETFs. The largest gold ETF, GLD, holds physical gold in HSBC vaults in London. That gold is allocated, meaning specific bars are assigned to the trust, but those bars are also part of the London Bullion Market Association system, which operates on an unallocated fractional reserve basis for most transactions. The same bar can appear in multiple accounting chains. It's not fraud in the legal sense, it's how the system is designed. But it means that in a rush for physical delivery, not everyone gets their metal. Bitcoin is cryptographically scarce, globally transferable, and requires no third-party validation to verify ownership. The supply cap is absolute, 21 million coins, enforced by protocol. You control the private keys, you control the asset. No vault, no custodian. No jurisdiction can freeze it unless they seize the keys, which requires physical access to the holder or catastrophic cryptographic failure that has never occurred in Bitcoin's 16-year history. The strength of Bitcoin is mobility, auditability, and resistance to confiscation. The weakness is network dependency, regulatory targeting, and the fact that most holders also don't self-custody. They hold Bitcoin on exchanges, in ETFs, or through third-party platforms. Same problem, different asset. Here's the critical comparison. Scarcity. Both are scarce. Gold's supply increases roughly 1.5% per year through mining. Bitcoin's increases on a declining schedule, currently around 0.8% per year, halving every 4 years, approaching zero. Silver's supply is higher, but tightening due to industrial demand that cannot be substituted. Solar panels, EVs, 5G infrastructure. You can't build a solar panel without silver. You can delay buying gold jewelry. You cannot delay building a power grid. Control. Gold and silver can be confiscated, restricted, taxed at the point of sale, or removed from circulation through legal tender laws. India imposes import duties on gold to discourage buying. China restricts gold exports. The US could theoretically reinstate Executive Order 6102. Bitcoin can be regulated at the on-ramp and off-ramp. Exchanges can be sanctioned, and self-custody can be criminalized. In 2023, the EU passed legislation requiring all crypto transactions above $1,000 to be reported. That's not about tax compliance, that's about surveillance. Neither asset is immune to state action, but both are resistant if held properly. Liquidity. Gold is globally liquid with established bid-ask spreads in every major city. You can sell gold in London, New York, Dubai, Singapore, Hong Kong, anywhere with a functioning bullion market. Bitcoin is globally liquid 24/7 with no market hours. You can move $100 million in Bitcoin on a Sunday at 3 a.m. with the same ease as moving 100. Try doing that with gold. Silver is less liquid than gold, but more accessible for small transactions and barter if the monetary system fragments regionally. Regulation risk. Precious metals face import, charm export restrictions, VAT in Europe, sales tax in some U.S. states, and reporting thresholds that trigger surveillance. In the U.S., dealers must file a 1099-B for certain bullion transactions. Bitcoin faces securities classification risk. The SEC has argued that most crypto assets are unregistered securities, which would make their sale illegal without registration. Exchanges face debanking, where traditional banks refuse service to crypto companies under regulatory pressure. Transaction surveillance is embedded in every proposal for central bank digital currencies. Both asset classes are under pressure. The pressure just comes from different directions. Physical versus digital ownership. Gold and silver are bearer assets. Possession is ownership. If you hold a gold coin, you own it. No database, no registry. Bitcoin is cryptographic ownership. Knowledge of the private key is possession. Physical can be lost, stolen, or seized by force. Digital can be hacked, lost through user error, or coerced through violence or legal pressure. Neither is perfect. Both require operational security, but the mechanisms are different, which means the failure modes are different. The point is this: they are not competitors, they are complementary. Gold is the anchor. It's the asset that has survived every empire, every currency collapse, every war. Bitcoin is the escape velocity. It's the asset that can cross borders in seconds, hide in 12 words memorized in your head, and verify its scarcity with mathematical certainty. Silver is the practical medium for small transactions if the system fragments and digital payments fail. And all three are being accumulated by actors who believe the current system is not reformable. Let's address the question no one asks on financial television. Who benefits from suppressing these exits? The answer is anyone holding liabilities denominated in currency and anyone who profits from the spread between real assets and financialized claims. Central banks benefit from gold price suppression because gold is the competitor to fiat currency. If gold rises too fast, it signals monetary failure. A rising gold price tells the world that the people managing the currency are losing control, so central banks lease gold into the market through bullion banks, creating synthetic supply that depresses spot prices. This is not conspiracy. This is documented in the footnotes of IMF and BIS reports. Leased gold appears on balance sheets as an asset even though it's been sold into the market. The buyer owns it. The central bank counts it. Double counting. This works until someone asks for delivery. Bullion banks benefit because they earn the lease rate, the carry trade, and the spread on synthetic instruments like unallocated accounts and ETFs. The London Bullion Market Association operates on an unallocated fractional reserve basis. Most gold traded in London is paper. Physical settlement is the exception, not the rule. In March 2020, during the pandemic lockdown, the gold futures market in New York experienced a massive dislocation. Futures prices traded at a $70 premium to London spot because there was no physical gold available for delivery in New York. Refineries were closed, transport was halted. And the paper market, which is supposed to track physical, broke. It reconnected only after the Fed intervened. That should not be possible in a functioning market. But it happened because the market is not designed for physical settlement at scale. In the Bitcoin market, suppression operates differently. Exchanges can create synthetic sell pressure by lending customer deposits to short sellers or by fractional reserving their own balance sheets. FTX wasn't an outlier. It was an exposure of standard practice. Sam Bankman-Fried used customer deposits to fund Alameda Research's trading operations. When withdrawals spiked, the liquidity wasn't there. The exchange collapsed. But here's the key. FTX was processing billions in trading volume. It was integrated with major institutions, and no one checked whether the Bitcoin on the exchange actually existed until it was too late. The lack of on-chain proof of reserves at most major exchanges means you cannot verify whether your Bitcoin exists until you withdraw it. And by the time you try, it may be gone. Regulators benefit by maintaining the fiction that Bitcoin is a speculative asset rather than a monetary alternative. If Bitcoin is classified as property, it's taxable on every transaction. Buy coffee with Bitcoin? That's a capital gain event. That creates friction. If stablecoins are classified as securities, their use is limited to accredited investors. That kills adoption. And if central bank digital currencies are introduced with programmable features, expiration dates, spending restrictions, negative interest rates, Bitcoin becomes the only non-sovereign, non-expiring digital money in existence, which is exactly why it will be targeted. The power dynamic is simple. The old system survives on the assumption that there is no viable alternative. Gold, silver, and Bitcoin are viable alternatives, so they must be marginalized, suppressed, or co-opted. The tools are different for each, leasing and paper gold for precious metals, exchange control and tax policy for Bitcoin, but the goal is identical: keep capital inside the system. History has seen this before. In 1933, President Franklin Roosevelt signed Executive Order 6102, which criminalized private ownership of gold bullion and required citizens to sell their gold to the Federal Reserve at $20.67 per ounce. 1 year later, the official price of gold was reset to $35 per ounce, a 69% devaluation overnight. Anyone who complied with the confiscation order lost purchasing power. Anyone who hid their gold, many did, preserved it. The justification was national emergency. The reality was monetary reset. The US dollar was backed by gold at the time, and the government needed to devalue without admitting insolvency. So it confiscated the asset, then repriced it. That's not ancient history. There are people alive today whose grandparents lived through that. In 1971, President Richard Nixon closed the gold window, ending dollar convertibility. Foreign central banks holding dollars could no longer redeem them for gold. The promise was broken, and the era of pure fiat currency began. What followed was not prosperity. It was stagflation, oil shocks, and the systemic breakdown of confidence in paper money. Gold rose from $35 in 1971 to over $800 by 1980, a 22x increase, not because of speculation, because the dollar lost its anchor. In Cyprus, 2013, depositors. In India, 2016, the government declared 86% of circulating currency invalid overnight. Citizens had weeks to deposit old notes or lose their value. The goal was stated as fighting corruption and black money. The result was economic paralysis, bank runs, and consolidation of financial surveillance. The informal economy, which employed hundreds of millions, seized up. People couldn't buy food, farmers couldn't sell crops, and the government collected data on every citizen who deposited cash. In Lebanon, starting in 2019, banks imposed informal capital controls. Depositors could not withdraw their own money in dollars. Accounts were frozen. The pattern is consistent. When the system is under stress, the authorities protect the system, not the people inside it. They freeze accounts, they control capital, they restructure liabilities, and they redefine what ownership means. The question is not whether this will happen again. The question is where, when, and what form it will take. Let's lay out the scenarios. Scenario 1, managed decline. Central banks continue coordinating stimulus, yield curve control, and selective bailouts. Inflation remains elevated but contained through statistical manipulation, changing CPI baskets, hedonic adjustments, substitution effects, and suppression of commodity prices through futures market intervention. The system limps forward. Growth is anemic. Real wages decline. But the structure holds. Gold and silver rise slowly, tracking loss of purchasing power. Bitcoin consolidates in a range, suppressed by regulatory friction and exchange under delivery. Wealth preservation requires holding hard assets. But the process is slow and the exits remain open. In this scenario, patience wins. You accumulate quietly. You avoid leverage. You don't try to time the market. And you wait for the compression event that forces repricing. That event could be 5 years away. It could be 5 months. But in a managed decline, you have time. Scenario 2, systemic fracture. A major sovereign default, a banking crisis, or a treasury market seizure triggers loss of confidence. It could be Japan, where the debt to GDP ratio exceeds 260%, and the central bank owns half of all government bonds. It could be the UK, where pension funds nearly collapsed in 2022 due to liability-driven investment blowups. It could be a cascade of regional U.S. bank failures, like we saw with Silicon Valley Bank, Signature, and First Republic. The trigger doesn't matter. What matters is the response. Capital controls are imposed. Digital currencies are introduced with coercive adoption mandates. Your welfare payment only works in the CBDC. Your tax refund is only available in the CBDC. Your employer is required to pay you in the CBDC. Physical gold and silver markets dislocate, premiums spike, delivery fails, and you can't get metal at any price in the retail market. Bitcoin becomes a refuge asset for international capital flight, but exchanges face shutdowns, debanking, and regulatory seizures. Self-custody becomes mandatory, borders tighten. In this scenario, early positioning is everything. If you don't already hold physical metal or control your Bitcoin keys, you won't get the chance. The window closes overnight. Scenario 3, coordinated reset. A Bretton Woods-style agreement revalues gold, introduces a new reserve currency backed by a basket of commodities or SDRs, and implements global taxation on Bitcoin and crypto. The G20 coordinates, the IMF administers. Debts are restructured, some written down, some extended, some converted to equity. Losses are socialized through wealth taxes, retirement account levies, or forced bond conversions. The public accepts it because the alternative is presented as total collapse. In this scenario, gold revalues higher as part of the reset. Central banks mark their gold reserves to a new official price. $5,000, $10,000, whatever number is required to backstop the new system. Bitcoin survives, but is regulated into a smaller role, legal to own, but tracked, taxed, and restricted for cross-border movement. Silver benefits from industrial policy and green energy mandates, but remains secondary to gold. Wealth is preserved if you held the right assets, but the rules change. What you could do with your gold in 2024 is not what you'll be allowed to do with it in 2027. None of these scenarios are guaranteed. All are plausible. And the right strategy is not to predict which one occurs. It's to position for all three. That means diversification across asset types, custody models, and jurisdictions. It means physical metal in your possession or in a vault you control directly, not a bank's vault, not an ETF's vault. It means Bitcoin in cold storage with proper security, hardware wallets, multi-sig, geographic distribution of backups. It means understanding that liquidity is a weapon, and the most liquid assets are often the most controlled. If you're watching this, you're not early. But you're not late either. You're in the window where information still translates into action. Most people are anchored to the belief that the system is stable because it has been stable in their lifetime. They believe dollars are money because dollars have always been accepted. They believe banks are safe because banks are insured. And they believe governments act in the public interest because they've been told that since childhood. You know better. You understand that currency is a claim on future productivity. And when productivity can't service the claims get defaulted, either openly through bankruptcy or quietly through inflation. You understand that banks are leveraged institutions that survive on confidence. And when confidence breaks, deposit insurance becomes a political question, not a financial one. The FDIC has $125 billion in its insurance fund. U.S. bank deposits exceed $18 trillion. Do the math. And you understand that governments act in their own survival interest, which sometimes aligns with the public but often does not. That knowledge puts you ahead of 95% of the population. But knowledge without action is just expensive entertainment. The action is simple. Remove wealth from instruments that depend on the system's stability and move it into assets that exist regardless of the system's stability. That means gold, that means silver, that means Bitcoin. Not as speculation, as insurance. And insurance works best when you don't need to file a claim. But if you do, you want to know the policy is real. Physical metal in a vault you control is real. Bitcoin on a hardware wallet you control is real. Everything else is a claim on someone else's promise. An ETF is a promise. A bank account is a promise. A treasury bond is a promise. And promises are the first thing that breaks when the pressure hits. You don't need to convince anyone. You don't need to wait for consensus. You don't need permission from a financial advisor who gets paid to keep you in the system. You just need to act while the window is still open. Because the liquidity compression window does not stay open indefinitely. It closes when the people managing the system realize too many people are leaving. And when it closes fast. Welcome to the Wealth Continuum. This channel exists for one reason: to analyze the structure of the financial system without the propaganda, the hype, or the bias of institutions that profit from your ignorance. We cover macroeconomics, monetary history, central bank policy, commodity markets, hard money, digital assets, and the mechanics of wealth preservation in a system designed to transfer value from savers to debtors. If that sounds like the kind of analysis you need, subscribe, turn on notifications, and understand that this algorithm does not favor content like this, because content like this does not serve the interests of the advertisers who fund the platform, but it serves your interest, and that's why it exists. New videos are released twice weekly. The next one covers the Basel III endgame and what it means for bullion bank leverage, gold leasing, and the structural instability of the London forward market. After that, we're analyzing central bank digital currency pilots in the EU and China, what they reveal about the control architecture being built, and why that architecture makes Bitcoin more valuable, not less. Until then, watch the spreads, watch the settlement failures, watch the capital flows, watch what central banks do, not what they say. The headlines will tell you everything is fine. The data will tell you the truth. And the truth is this: we are in the late stage of a currency system that has lasted 50 years. Most currency systems last 60 to 80 years before they reset. We're not special. The reset is coming. The only question is whether you're positioned for it. Stay ahead.